Hello everyone, welcome to chapter 5 of the Access Cycle. This chapter is about building anticipatory skills. Okay, now before I actually get into the details of this chapter, let me first of all define what anticipatory skills are and what I mean by this term. Now, the way I would define this term is that basically anticipatory skills or anticipation skills are your ability to look at the market or look at the trading asset that you're trading at the start of the day and make an educated and an informed and a probabilistic judgment, or basically a probabilistic guess about where expansion is most likely to occur, meaning in which direction expansion is most likely to occur for today, when that expansion is most likely to happen, and most importantly, is expansion for today even likely? Meaning, are we even going to have an expansion for today, or are we just going to have a consolidation, or maybe we're going to have counter short-term price action in the opposing direction? Okay, that's basically what I mean by anticipatory skills. Okay, it's about forecasting the nature of the day before it unfolds. And obviously, you do that using the concepts that I've taught you and using the structure and the logic within those concepts. Okay, that is what I mean by building anticipatory skills. Now, the purpose and the objective of this chapter is so that I could plant this idea in your mind and make this idea clear to you that your only objective or your main objective as a day trader or for day trading is only to determine where, when, and in which direction the daily range expansion will occur only for this exact day that you're trading, only for today. Again, not tomorrow, not the next day, not the day after tomorrow. Okay, your main objective is not to predict where the market will be tomorrow or what the next week's candle will look like. Okay, your job is singular. Your objective for day trading or intraday trading is singular, and that is to figure out if price is going to expand today. Okay, and if the answer is yes, then you have to figure out in which direction that expansion is most likely to occur. Okay, that's it. That's literally your entire objective. And the reason I'm telling you all of this, even though it may seem simple or even though it may seem cliche and you may already know about it, and the reason all of this matters is because let's say you could have a weekly bearish bias. Let's say you are expecting the current week to expand lower. Okay, now even though the higher time frame is telling you that the week is going to expand lower and we are going to have a weekly expansion lower, that doesn't mean that every single day of the week will have that expansion lower. Okay, that doesn't mean that every single day of that week will push lower, because some days will be consolidation, some days will have counter short-term price action in the opposing direction, and maybe only 2 or 3 days will actually have the true expansion towards the downside, or the true expansion days towards the downside, instead of the whole week or instead of every single day of the week being an expansion lower. And if you don't understand that distinction between expecting and anticipating weekly range expansions and daily range expansions, you will end up trading low probability conditions on the wrong days, and you will end up forcing setups or forcing trades on days where price isn't even meant to expand. And that's exactly where unnecessary losses come from. Okay, that's exactly how unnecessary losses are born. And the truth here is that most traders lose money not because they don't know the direction, but because they don't know when that direction that they're expecting actually expresses itself. Now, a simple example of this would be, let's say that you are coming into the week with a bearish expectation for price. Okay, you've done your higher time frame analysis, and the higher time frame monthly, weekly, and the daily chart shows that we have liquidity to be taken below, and we are expecting this week to have a bearish range expansion lower, and your expectation for the week is basically bearish. And with that bearish expectation in mind, you come in on Monday, and because you've already decided that the week is going to be bearish, you start shorting right away. You start looking for bearish trades right away from Monday. You start establishing bearish market context on the 4-hour right away from Monday. And then you enter bearish positions aggressively, thinking that this is the start of the bearish move, and now we're going to have the bearish expansion lower. And obviously that ends up, and what ends up happening is you lose those trades. And the reality in that scenario, in that situation, is that not every day or not every day of the week is meant to have a true expansion. What usually happens is that Monday or Tuesday or both of them together usually forms the high of the week, meaning they together often create counter price action, first of all, against the weekly buys, against the weekly expectation before the real expansion happens. Okay, so instead of expanding straight away lower on Monday, what usually happens is that Monday basically either forms the high of the week and has counter price action against the weekly buys, or it forms a range which then gets taken, or which then gets purged on Tuesday, and Tuesday forms the high of the week, and only then we have the true expansion lower. And because you fail to recognize that, and because you fail to distinguish or have the correct distinction between that, you straight away entered bearish trades, and then those bearish trades ended up being losing trades, even though you had correctly determined that we were going to have a weekly range expansion lower. And it wasn't that your idea was wrong in that context or that scenario, it's just that your timing was wrong. You were early. Okay, you entered too early before we even had the true expansion. It was that you hadn't yet built these anticipatory skills, which would have given you this ability to differentiate between expansion days, high probability days, and low probability days where you're not meant to trade. That's something you should avoid at all times. You should avoid treating every day of the week as an expansion day. You should avoid expecting every day of the week to be an expansion. Okay, instead what you should be doing is that you should come into each trading session, each trading day, asking yourself this one important question, which is not basically asking but assessing and measuring whether today is one of those high probability expansion days or not. Whether are we going to have an expansion, a high probability expansion or not. And that single distinction will change everything for you. Because when you identify days where expansion isn't likely, where we won't have a range expansion, where the probability of an expansion happening isn't likely or is low, then you instantly filter out half of your bad trades. And due to that, you not only save your capital, your emotional energy, but more importantly, you save your confidence from unnecessary drawdowns. You save yourself from forcing trades in low probability conditions. You save yourself from forcing trades on days where expansion isn't likely. And this is why I say you trade the day, not the week. Okay, you react to what's unfolding on the day currently and not what you wish would unfold. Okay, your skill isn't in predicting whether the week will end bullish or bearish, even though that's important. Your main skill as a trader lies in recognizing when the daily range expansion is likely to happen and when it's not. And when you get good at this, your entire decision making process becomes sharper and it improves. So the bottom line here is that even if the weekly structure says we're going to go lower, even if the weekly time frame analysis say that we're going to have an expansion lower, you still have to ask yourself and measure and find out and figure out, is today the day that expansion actually happens or not? And if it's not, then forcing a trade in that context, in that scenario, forcing a trade there just means that you are donating money, you're donating liquidity to the market. Okay, so what you should do is you should shift your mindset from predicting direction to anticipating the expansion window. Okay, you should shift your mindset from predicting direction to building anticipatory skills that help you anticipate the expansion window. Okay, and that way your trading essentially becomes more controlled. Okay, and here's how that process looks like for me. First of all, I look at the weekly profile. I study the current weekly profile along with the weekly and the daily open high low close framework, and I study them to determine how price is currently positioned relative to the high time frame buys. Meaning, are we opening inside a previous week's range? Have we yet formed the high of the week or not? Have we yet tested a higher time frame key level or not? Okay, and all of that basically gives me a critical context to judge what type of day could we have. Could we just have a ranging day or an actual true expansion day, or could we just have short-term counter move in the opposing direction to maybe rebalance the dealing range from the high of the week? Okay, and I judge that, I assess that based on these three things: the weekly profile, the weekly open high low close, and the daily open high low close framework. And then after that, I look at the Asian session, because the way the Asian range builds up, it helps us set our expectation for the rest of the day for range expansion. For example, if Asia consolidates, if the Asian range is a consolidation, then in that case, London usually tends to be an expansion. But if the Asian range has already had an expansion before, then in that case, London tends to usually be low probability. And then in that case, I then trade the New York Open and the range expansion, the true expansion. In that case, usually then occurs at the New York Open session. Okay, so just to basically summarize everything, the skill here is in recognizing is today likely an expansion day or a range day. And if expansion is coming or it's expected, where could it originate from and which direction has the highest probability? Okay, the most important element here is this one, which is to figure out or determine, is today likely an expansion day or not, or is it just a ranging day, or could it have short-term counter transaction against the weekly buys? Okay, and by building these anticipatory skills, by improving these anticipatory skills, you'll naturally focus on high probability market conditions, and you'll have the patience to not expect every day to be an expansion like a monkey. Okay, you would stop expecting every day to be an expansion. Okay, so right here, let me give you a few examples of what I mean by having the correct anticipatory skills or the correct anticipation skills. So first of all, let me analyze this price action for you. And I'll first of all build the directional bias here, and then we'll look at some examples of how you could distinguish or differentiate between true expansion days and ranging days and days where expansion isn't likely. Okay, so first of all, looking at this price action, you can see that we have this bullish dealing range. What we did is that from this point on, we had a bearish retracement lower, and with this retracement lower, we rebalanced this dealing range by reaching the discount key level, the discount region of this dealing range, and testing a discount key level within this dealing range and taking out this discount low. Okay, so now that we've rebalanced this dealing range and also had a CSD here, okay, our expectation for price is now for it to have a range expansion higher and eventually take out this high. Okay, our drawn liquidity based on the analysis that we just did and based on this price action is now this high and this high, and the directional bias is bullish. You can see that last week Friday closed higher and we had a change in the state of delivery or a structural shift. Now for the next week, based on this analysis that we just conducted, our directional bias for the week would be bullish. Okay, then next week we will expect price to have a bullish range expansion higher towards the drawn liquidity. Okay, now let's say we have two types of traders dealing with this price action or dealing with this weekly directional bias which is bullish. We've got trader A and trader B. Now trader A is fully equipped with the correct anticipatory skills, meaning he knows what weekly profiles are and their significance, what their significance is. He is aware of the weekly open high low close framework. He is fully equipped with that knowledge, and he also knows the importance of higher time frame key levels and how they act as catalyst for true expansions. Whereas on the other side, we've got trader A who might know about these things, but he doesn't actively uses them, and he hasn't yet built these anticipatory skills or these anticipation skills that are required to know whether we could have an expansion for the day or not. Okay, now in this case, if your anticipation skills were similar to trader A, which means they were next to none, if not none, then you would have straight away expected Monday to be an expansion day, and you would have expected Monday to be an expansion higher, because that's what this analysis is telling us, because that's what the analysis that we just conducted is telling us, because the drawn liquidity is higher, the weekly directional bias is bullish. So obviously Monday is supposed to be bullish, right? But if you were trader B, then you would have correctly expected that first of all, we form and establish the low of the week at a higher time frame key level, either on Monday and Tuesday. And then once we've done that, we then have the true expansion higher. Okay, so now let's see what price action actually did. You can see even though that the weekly directional bias was bullish, even though that the drawn liquidity was higher, if you had looked for trades on Monday, then obviously those would have been losing trades, because you can see Monday closed lower. Okay, instead your correct anticipation for Monday in this case would have been to expect it to be either a ranging day or a bearish day in the counter direction, so that it would form the low of the week. Okay, and you can see that would have been the correct anticipation for Monday in this case. And then on Tuesday, you would have expected the first half of it to have price action lower to test the higher time frame key level, establish the low of the week there, and then from that point on, you would have expected an expansion on Tuesday. Okay, and then similarly on Wednesday, you can see that now we've established the low of the week on Tuesday. We've tested a higher time frame key level, and that has established the weekly profile structure. And now based on the weekly open high low close framework, we can expect Wednesday to be a true expansion higher. And let's see what happens. You can see your anticipation on Wednesday would have been correct, and you would have traded this expansion higher. And you had this correct anticipation for Wednesday because you used these necessary concepts right here. And the same thing for Thursday. You would have expected Thursday to be an expansion as well. And you can see even though Thursday didn't have the expansion, it still had bullish price action, and you would have been right. But then on Friday, your correct anticipation would have been not to expect it to be in another expansion, but expect it to be either a ranging day or a retracement day, because you can see we've had our range expansion for the week. We've now reached an opposing key level, and in those sort of context, in that sort of context, Friday then usually tends to either be a ranging day instead of it being in another expansion higher like this. And then same thing for Monday. Instead of expecting Monday to be an expansion higher, you would have expected it to first of all test this high time frame key level, establish the low of the week there, and then from that point on you would have expected two expansions on Tuesday and Wednesday. But if this week you had expected Monday to be an expansion like we did last week, then you would have been wrong, because you can see Monday had bearish price action, and with that we tested a high time frame key level, we established the low of the week there, and then from that point on, based on the weekly profile structure and based on weekly profiles, you would have then expected Tuesday and Wednesday to be an expansion higher. Okay, so you can see that's why having these anticipatory skills is so important, and that's why being able to differentiate between the weekly directional bias and the daily directional bias is so important, because the weekly directional bias could say that it's bullish, but that doesn't mean that you expect every day of the week or every day to be bullish. Instead, you use these concepts, you use the logic within these concepts like the weekly profiles, the weekly and the daily open high low close frameworks, and then based on that you assess and measure whether today could be an expansion or not. Okay, you look at the higher time frame context, you look at higher time frame key levels, you look at the open high low close framework, and then based on that you determine whether we could have an expansion today in the direction of the weekly bias, or we are going to first of all establish the low of the week or the high of the week depending upon the context, and only then are we going to have that true expansion that we're expecting. Okay, now in this slide you can see we've got the benefits of having anticipatory skills, or the benefits of building the correct anticipation skills. You can read them yourself right here. These are basically just the direct and the indirect results of having the correct anticipatory skills. Some of them are related to the psychological aspects of trading, some of them are related to the technical aspects. Okay, I just showed them to you on the charts, but you can read them yourself here as well.